Let's get started. Hi, everybody, and welcome to this webinar hosted by the Jacobs Levy Equity Management Center for Quantitative Financial Research at the Wharton School. My name is Chris Gatesy, and I'm one of our academic directors of the center, along with Craig McKinley. Today's webinar will focus on the working paper, The Return of Return Dominance, Decomposing the Cross-Section of Prices by Sean Myers of Wharton, and his co-authors from the University of Southern California and City University of London. It will be presented by Sean and discussed by John Lewellen, the Carl E. and Catherine M. Height Professor of Finance at the Tuck School of Business at Dartmouth. I know many of you are familiar with the Jacobs Levy Center and have attended our past webinars and conferences. However, for any newcomers, it's important that you know our mission is to advance research in quantitative finance that sits at the intersection of theory and theory. The Center awards doctoral fellowships and research grants to Wharton and Penn faculty and student projects, maintains a paper series on SSRN, and hosts events like this in the annual Frontiers in Quantitative Finance Conference. The Jacobs Levy Center and the Wharton Jacobs Levy Prize for Quantitative Financial Innovation were established through the vision and generosity of Wharton alumni Bruce Jacobs and Ken Levy, who made a gift to Wharton to commemorate the 25th anniversary of their firm, Jacobs Levy Equity Management. Bruce and Ken have played an ongoing major role in bringing quant investing to the forefront, publishing a series of significant articles in leading professional journals, co-investigating and co-authoring well-regarded books, and generally fostering scholarship in the finance field. We thank them for their ongoing support and involvement, which have helped ensure Wharton is at the forefront of the field of quantitative finance. I'll pass this off shortly to Sean to begin his presentation of his paper, which examines the conventional belief that PE ratios are primarily linked to future profitability in the long run, highlighting the importance of considering returns on investment rather than looking at profitability alone in stock valuation assessments, with implications for the use of PE ratios and the ongoing question of value versus growth. The paper won the 2023 Jacobs Levy Center Research Paper Prize for Best Paper. We'll dive into the paper presently, but first, a bit more on our speakers. Sean Myers is an assistant professor of finance at the Wharton School. His research focuses on macroeconomics and finance with a particular focus on subjective expectations, a topic of considerable importance these days and enduringly. Some of his recent work focuses on the cross-section of subjective expectations, the impact of errors in expected long-term inflation, and the effect of public pension obligations on a government's commitment to repaying debt. His research has appeared in leading economic journals, including the RFS and the Journal of Finance. Our discussant, Jonathan Lewellen, is the Carl E. and Catherine M. Height Professor of Finance at Dartmouth's Tuck School, as I mentioned, and a research associate at the National Bureau of Economic Research. Before joining Tuck in 2005, John was on the faculty at MIT Sloan. John's research focuses on stock prices and investor behavior, with additional interest in corporate finance and accounting, and his research has been published in leading journals, including the Journal of Finance, the Journal of Financial Economics, the Review of Financial Studies, and the Journal of Financial and Quantitative Analysis, and I think many of us have read his papers. So welcome, Jonathan and Sean. Everybody, we will have a Q&A period after the discussion. If you have a question, please, if you'd be so kind, submit it via the chat, really at any point. We're collecting them and curating them. Please also note whether you're comfortable being called on to ask your questions aloud. We'll try to do that whenever possible to help make today's session interactive. So with that, please welcome Sean as I turn it over to him. Sean?
Thank you so much. All right, let me just get the technical elements out of the way. Okay. Perfect. Okay. All right. So before diving in, let me just note that this is joint work with Ricardo De La O as well as Xiao Han, and that obviously we've really benefited from the support of the Jacobs Levy Center, and so we're just very grateful for that continued support for this type of quantitative research. So in this paper, we're going to ask a fairly basic question, which is just, do price ratios for stocks mainly predict future earnings growth, or do they mainly predict future returns? So we know from present value relationships that there needs to be a tight link between prices, earnings, and returns. And in particular, this is a quantitative relationship. So approximately what we have is that a stock with a 10% higher price earnings ratio needs to have either 10% higher future earnings growth or 10% lower future returns, or some combination of the two. But the main thing is that it needs to add up ultimately. So we need to see not just which direction earnings growth and returns go, but quantitatively how large is the future returns, how large are the future earnings growth. Now, we're certainly not the first paper to study this topic. This is a fairly long-standing issue in asset pricing. So at the aggregate level, it's been well documented that price ratios are mainly related to future returns, not to future dividend growth or future earnings growth. In comparison, in the cross-section, there are findings from Fama and French, Voltanahu, Cohen, Polk, and Voltanahu that have argued that price-book ratios are mainly related to future profitability, not the future returns. Now, combining this seemingly contrasting results for the aggregate time series versus the cross-section, it's given rise to this idea that the market is micro-efficient, but macro-inefficient, in the sense that in the cross-section, price-book ratios are largely related to future profitability rather than returns, whereas in the time series, these price ratios are mostly related to future returns rather than future cash flows. Now, despite this previous literature, what I'm going to argue in this paper is that we find that the cross-section of price ratios is mainly related to future returns, not to future earnings growth, and in fact is quite similar to what we see in the aggregate time series. So just to give an overview, the paper centers around three main results, where the unifying theme is that these are all going to utilize a present value relationship. And we're going to try our best to be very careful to reconcile each of our results with the previous literature, really emphasize that none of the stated results in these previous papers were incorrect. This is purely just about how we should interpret these results and whether we should think of the cross-section as being particularly efficient or thinking that growth stocks have high earnings growth. So for the first exercise, we're going to focus on decomposing cross-sectional differences in price ratios, both price earnings ratios and price book ratios. The main result here is that we find that future returns account for 75% of all price earnings ratio variation, whereas earnings growth only accounts for about 25%. So rephrased, what we find is that growth stocks do have higher earnings growth than their peers, but it's only enough to justify about 1/4 of the difference in PE ratios. The other 3/4 comes from high PE ratio stocks having lower returns than their peers. Now, the fact that we're getting so much of this coming from future returns is going to pose a pretty big quantitative puzzle, because it implies either very large risk premia or very large amounts of mispricing, or some combination of the two. And importantly, we'll be very explicit to reconcile this with the previous results on price-book ratios and future profitability. Okay, the second result is we'll look at some implications for long-term return predictability. The result I'll focus on today is that we find that price-earnings ratios are a stronger predictor of returns than price-book ratios, and perhaps evidence based on long-term predictability using price-book ratios has been understating how predictable long-term returns are. One element we go into in the paper that I'm going to, for the sake of time today, not dive into, is that we actually show that the lack of predictable earnings growth actually gives you some additional evidence that returns are returns are predictable, as long as price ratios are stationary. And we reconcile that with recent evidence from Keloharju et al. In 2021. Then the last element is, instead of focusing on the level of price ratios and the level of returns, we'll decompose innovations in price ratios and current returns. And we'll find a similar result here, that we find that innovations or changes in price ratios and returns are largely driven by revisions to future expected returns, not revisions to expected earnings growth. And we'll again reconcile this with some of the previous literature. Now, just before I dive into the results, to give kind of the big picture point here, why do all of these decompositions matter? And why do we put so much effort into trying to reconcile each of the results with the previous literature? It's because if I can convince you of these results, then it creates a pretty fundamental change in the way we view or model how companies are being valued. What the results show is that the cross-section of price ratios is not justified by future earnings growth. And instead, if we're thinking about these price ratios, there needs to be a very large role for either mispricing or substantial risk premia when evaluating price ratios. And I'll talk a little bit about models to really emphasize that it's quite difficult to justify that 75% of differences in price earnings ratios just comes from differences in, say, risk premia or risk exposure. Okay, so throughout this talk, I'm going to be using the same data set, and intentionally, it's a fairly bland data set. So there is no innovation here on this front. So we're going to be looking from 1963 to 2020 off of all stocks traded on major indices. We're going to sort stocks into the classic value versus growth portfolios. Specifically, each year, we take all stocks and sort them into 5 portfolios based on their price-book ratios. And then holding the portfolios fixed, so without rebalancing, we're going to track the buy and hold future earnings growth, returns, price earnings ratio, and price book ratio over the next 15 years, essentially to track how one cohort of firms does compared to, say, an alternative cohort. In the paper, we do robustness checks with different numbers of portfolios. And today I'll discuss one specific check we do where we look at firm level variation instead of aggregating into portfolios. Okay, so just to jump in, I'll spend the majority of my time on this first exercise, decomposing cross-sectional differences in price ratios, then talk about long-term returns, and finally wrap up with some results on price ratio innovations and current realized returns. So for the cross-section of price ratios, let me just start with the price earnings ratio. So we want to start with some decompositions that link price earnings ratios, future earnings growth, and future returns. So we'll start from an approximate log return identity that conveniently holds even if firms have no dividends. So this approximate log return identity is that the return on asset I is approximately equal to its 1-year earnings growth, its future price earnings ratio times this log linearization constant rho that's fairly close to 1, minus the current price earnings ratio. If we were to do this with capital gains instead of returns, then this would be an exact identity. Now, if you rearrange and iterate this identity, you get a fairly familiar formula, which is stating that the price earnings ratio is approximately equal to future earnings growth minus future returns plus the future price earnings ratio. So mechanically, if a stock has a high price earnings ratio, it has to either have high earnings growth going forward, a high future price earnings ratio, or if it has neither of those, if the earnings don't grow and the price earnings ratio doesn't stay high, then mechanically it's going to have a low return. Now, using this relationship, we can then decompose cross-sectional differences in price earnings ratios. So the variation across I in price earnings ratios has to be due to high price earnings ratios positively predicting future earnings growth, high price ratios negatively predicting future returns, or high price ratios predicting high future price earnings ratios. Now, if we divide everything by the variance, we can essentially scale all of these objects to measure what portion of the total variation comes from the green, red, and blue terms. So once we rescale everything by the variance, we'll call the green term the cash flow growth news, which is how much are price earnings ratios giving you information about future earnings growth. The red term will be discount rate news, so how much are price earnings ratios telling you about future returns. And blue will be news about the future price earnings ratio. Now, throughout the talk, I'll be doing a couple different decompositions. So to try to keep things coherent, you can always think of any of the green terms indicate that high price ratios are related to future growth. So you can think of green for good growth. Red is going to be for bad returns. So it's indicating that high price ratios are, in a sense, either overvalued or some type of hedge, and they just get bad returns going forward. Now, the convenient thing is that because these are just covariances divided by a variance, these are just regression coefficients. So for example, the cash flow growth news term is just obtained by regressing future earnings growth on the price earnings ratio with time fixed effects, so that we're looking at cross-sectional differences. And you can do analogous regressions to get the discount rate news and the future price earnings ratio news. So if you don't want to think of this in terms of decompositions, you can just think of this in terms of predictive regressions. The price earnings ratio needs to predict future earnings growth, negative returns, or the future price earnings ratio. Now, as a final note, what we find is that this approximation, while it's not an exact identity, it holds fairly tightly. So if we add up these three components, they sum to 1.002 or 0.987 across different horizons of 1 to 15 years. So it's always within 1.5% of the total. We can include additional terms like payout ratios to move this total decomposition closer to 1. But the main point is just that empirically, a 1-unit increase in the price earnings ratio shows up almost 1-for-1 as higher future earnings growth, lower future returns, or a higher future price earnings ratio. So what we find is that the vast majority of differences in price earnings ratios show up as differences in one of these three components. So to jump to the main result, what do we find when we estimate this decomposition? So we can estimate each of these three terms at different horizons H. So we can look at 1-year earnings growth, 2-year earnings growth, etc. This graph summarizes what we find. So the dots show our estimates for cash flow growth news at different horizons ranging from 1 to 15 years. Red shows our estimates for discount rate news, and blue shows our estimates for the future price earnings ratio news. The dots are the direct estimated coefficients just from running a simple univariate regression. And then for comparison, the dashed lines show what you would get out of a VAR model, just to emphasize that you would get fairly similar quantitative results. Now, the main outcome here is that we see that high price earnings ratios do predict higher future earnings growth. So growth firms do have higher earnings growth than their peers, but it's only enough to justify about 20% of the differences in price earnings ratios. So what we see is that the cash flow growth news is just quantitatively not very large. Instead, quantitatively, the bigger component is that high price earnings ratios very strongly predict lower future returns. And as we increase the horizons, we see a fairly robust kind of 2-to-1 or 3-to-1 relationship, where price earnings ratios are predicting both earnings growth and returns, but quantitatively, it's mostly predicting lower future returns. Okay, so with the price earnings ratio out of the way, I now want to relate this to looking at price book ratios, which is just simply the inverse of book to market. So we can pretty easily connect this to price book ratios by just seeing that the price book ratio is the price earnings ratio plus the ratio of earnings to book, where all these variables are just in logs. What this means is that because the price earnings ratio is approximately equal to future earnings growth minus future returns, the price book ratio just picks up this extra term. So the price book ratio is just the earnings to book ratio plus future earnings growth minus future returns. We can then do a similar cross-sectional variance decomposition where variation in price book ratios has to be due to a high price book ratio being related to current earnings to book ratios, a high price book ratio predicting future earnings growth, or a high price book ratio predicting lower future returns. And the main point I want to emphasize here is that there may be variation in price book ratios that's not related to future earnings growth or to future returns. So compared to the last decomposition, we essentially pick up this extra component here that's not informative about any of the future objects. So why does this term arise? It's because while prices are forward-looking and deal with discounted expectations of future cash flows, book is just a backwards-looking record of how a firm got to this point. It's just a record keeper of essentially the history of this firm. So when we're looking at price-book ratios, it's telling us some information about future earnings growth, some information about future returns, but also it may just be indicating this past component, just what is the current earnings to book ratio. Now, to estimate these three pieces, again, we can just do regressions with time fixed effects, and we can also use the VAR to get these full horizon cash flow growth and discount rate news. So what do we find for the variation in price book ratios? The first point I want to highlight is that we find that this past component is fairly large. So we find that almost half of variation in price book ratios is not related to future earnings growth or to future returns. It's just capturing current correlation with earnings to book ratios. Now, of that remaining half that is related to future earnings growth and future returns, what we find is that it's largely related to future returns rather than future cash flow growth. So again, if we go back to the graph, here we plot in dots the direct estimates of this cash flow growth news at different horizons. We see that there's some evidence that high price book ratios predict higher future earnings growth, but it's just nowhere near as large as what we need to justify these differences in prices. Ultimately, it can only account for about 10% of the variation in price book ratios. Instead, quantitatively, the much larger component is that high price book ratios negatively predict future returns. And if we use this VAR estimate, what we find is that this accounts for about 40% of variation in price book ratios. Okay, so let me do a reconciliation before kind of putting together these results and giving a clear takeaway message. So what we want to clearly relate to is this previous work that studied profitability, where profitability was defined as pi, which is just 1 plus the future earnings over book. Now, there's this strong existing result that price book ratios are very informative about future profitability. In fact, similar to the decompositions we're doing, what they show is that the price book ratio can approximately be written as the sum of future profitability minus future returns. Then you can do a similar variance decomposition where differences in price book ratios have to be due to price book ratios positively predicting future profitability or price book ratios negatively predicting future returns. Now, I just showed on the last slide that we estimate this red term, and we find that it accounts for about 40% of variation in price book ratios. So already from what we're showing, we find that this black term here accounts for almost 60% of the variation in price book ratios. So we're in complete agreement with the previous literature that future profitability seems to account for a lot of variation in price book ratios. So what's going on? Kind of what's this tension between profitability and earnings growth? What we highlight here is that profitability takes earnings and scales them by book value. So again, it's mixing this information about the future with some information about things that have already happened. Specifically, what we find is that future profitability can be split into two terms. There's the future earnings growth, and there's also just the current earnings to book ratio. Intuitively, what this is saying is that there are two ways for a firm to have high future profitability. It could grow its earnings faster than its peers and become highly profitable that way. Or it could just start off with higher earnings relative to book value than its peers. And then even if it has the exact same earnings growth as all of its peers, it will continue to have high profitability going forward. Now, what we show is that, again, there is a strong co-movement between price-book ratios and future profitability, but it's almost all driven by the fact that price-book ratios are related to current earnings to book ratios, not that price-book ratios are very informative about future earnings growth. So it seems to mostly be this current piece, that price-book ratios are not signaling future earnings growth. They just tell you that book value may be low for this firm. So book value may be low relative to price, and book value may be low relative to the earnings. Now, to put this together, this is intentionally a very stylized example, but I think it gives a good piece of intuition here for how these results can come about. So consider a case where we have two firms with identical future earnings growth and identical future returns. But one firm L has low book value, while firm H has high book value. This might be due to differences in capital intensity, intangible differences between these firms, or just differences in their accounting standards. The main point here is that this is something that's already occurred. Again, it's nothing related to their future returns, nothing related to their future earnings growth. Then what we would find is that the low firm has a higher price book ratio than firm H. The two firms have identical earnings growth, but the low book firm will have higher future profitability. This would give you a result where the price book ratio would predict future profitability, but be uninformative about future earnings growth. Why is this happening? It's because both the price book ratio and profitability are related to current book value. So before diving into the other results, I kind of just want to put together these two main decompositions with this reconciliation. So first, it's completely fair. The previously documented result is still true, that price book ratios are strongly related to future profitability. But this shouldn't be interpreted as price book ratios predicting future earnings growth. So if we want to call these high price book ratio firms profitable firms, that's fine, but maybe we shouldn't call them growth firms because they don't really have much more earnings growth than their peers. Calling them growth firms is almost a misnomer and seems quite misleading. In fact, when we break down these decompositions, what we find is both price earnings ratios and price book ratios are much more related to future returns than they are to future earnings growth. Specifically, we consistently find that discount rate news is much larger than cash flow growth news. And this is quite similar to what we see in the aggregate time series. So what this means is that we don't seem to find that the cross-section is any more related to future cash flow growth than the aggregate time series of stock prices. So both of them seem equally puzzling. Now, this opens a big question, which is, if it's not future earnings growth, what is explaining all of this cross-sectional variation in price ratios? So why do some firms trade at 70 times earnings while other firms trade at only 10 times earnings? Our results indicate that it needs to be either substantial mispricing or risk premia. So just to give a quantitative sense of how large these risk premia mispricing would be, let me dive a little bit into models, and then I'll discuss robustness tests for these main results. So to get a sense of these results, we calculate 6 different cross-sectional asset pricing models. And generally what we find is that it's quite difficult to generate discount rate news as large as what we find in the data. So in this top row, I'm listing the estimates for cash flow growth news that we find in the data, as well as our estimates for discount rate news. Now, if we look at models of risk premia, whether that's based on growth options, irreversible capital, duration risk, or technology risk, overall, these models all imply that price earnings ratios should be very informative about future earnings growth. And in fact, the vast majority of differences in price earnings ratios should be explained by differences in future earnings growth, according to these models. Now, these models do generate differences in future returns. And in fact, all of these models generate a 1-year value premium. But what we emphasize is that just matching the value premium isn't enough to generate our results. So even though these models generate a value premium, they're still generating discount rate news that's substantially smaller than what we see in the data. In particular, for these first three models, we're a full order of magnitude off of what we find in the data. So in general, it's difficult to generate a model where, say, the difference between my price earnings ratio and John's price earnings ratio is largely due to differences in me being a great hedge or John being more exposed to risk. It's difficult to get a model where that's half to 75% of all of the price earnings ratio differences. Now, if we look at mispricing, it's again not trivial to match these facts. So even if you move away from risk premia and include mispricing, it's still a case where most of these models are generating mispricing that's just too small to match what we find. So our results aren't just saying that it's difficult to match with risk premia. We're saying that even mispricing models would need a fairly substantial amount of mispricing. Now, we do evaluate a sixth model, ironically, one of John's models. So what we find is that the learning model of Lewellen and Shanken is the one that comes the closest to our results, where it has very little relationship between price ratios and future earnings growth, and a very strong relationship between price ratios and future returns. Now, I'll do this quickly, but to get a sense of this distinction between risk premia and mispricing, in a subsequent paper, we use professional analyst forecasts to try to disentangle these two elements. And what we largely find is that the low realized returns on high price earnings ratio stocks seem to be about 1/3 risk premia. So the analysts partly foresee this and do report differences in risk exposure between these stocks, but about 2/3 of it seems to come from overly high cash flow growth expectations. So at least if we base this off of analyst forecasts, a lot of these low returns on high price earnings ratio stocks seems to be because people were anticipating very high earnings growth and it just didn't materialize. So they were let down by the future earnings growth. Okay. Now, with that said, let me talk a little bit about robustness tests before doing long-term returns and price ratio innovations. So we do a lot of robustness tests throughout the paper. I'm just going to focus on a couple of them here for today, which I'm hoping will be the most relevant. So the first is looking at this result over time, rather than taking the full sample. So what we do is we estimate our discount rate news and cash flow growth news over a rolling sample. So we take all the observations up to time t, and then we do geometric weighting, where we put half the weight on just the most recent 5 years. So say in 2005, this would say we look at price earnings ratios for all of these portfolios, but we're going to mostly focus on just the most recent 5 years. Then we compare those price earnings ratios to the future 15-year returns from, say, 2005 to 2015. And what we find is that about half the variation is explained by future returns, and only about 20 to 30% of the variation is explained by future cash flow growth. Now, there's certainly some large variation in these estimates over time, but the surprising thing we find is that there's really no time period where earnings growth was high enough to justify, say, 50 or 60% of the variation in these price earnings ratios. And it certainly never gets close to 100%. So while the estimates may fluctuate, we find fairly consistently that future earnings growth is just not large enough to explain all of the variation we see in price earnings ratios. And instead, a lot of this shows up as differences in future returns. As a second quick robustness test, we look at different price ratios. So we consider price sales ratios, price employees, price to smoothed earnings. And again, we keep getting a consistent result where price ratios are informative about future earnings growth, but the relationship is small. Instead, the much larger quantitative relationship is that high price ratios negatively predict future returns. And we see that across all the different price ratios that we consider. The last robustness test I'll talk through is that we do a firm level decomposition. So for our normal log approximation, we apply this to portfolios, where by adding up a large number of firms, we can somewhat avoid the issue that individual firm earnings may be negative or zero. Now, if we take this to the firm level data, it means that we can't use some of the classic log decompositions. So what we show is that instead, we can look at changes in earnings yields and split this into two pieces. The first piece is holding the price fixed. You can measure how much the earnings yield would have changed if you only changed the earnings. So you can measure this at the original price and at the new price. The second piece is holding the earnings fixed. How much would the earnings yield have changed if you just changed the price? Again, doing this at the original earnings and at the new level of earnings. Now, what we can then ask is, does variation in earnings yields predict changes in earnings yield due to movements in earnings, changes in earnings yield due to movements in prices, or the future earnings yield? And what we get overall is something fairly close to our portfolio level results, where we find that high earnings yields do somewhat predict a decrease in earnings, but this only accounts for about 10% of the variation. High earnings yields do predict an increase in price, and this is quantitatively the much larger piece, accounting for about 70% of the variation. And then the remaining 20% comes from high earnings yields predicting high future earnings yields. So broadly, what we find is that differences in earnings yields are explained by prices catching up to earnings, much more than earnings moving to align with prices. Okay, in the last 5 or 8 minutes, let me talk through these last two exercises, which will be a bit shorter. So the first is looking at some of the predictions for long-term returns. The main point I want to emphasize here is that from these identities, we know that all variation in price earnings ratios that's not related to future earnings growth needs to show up mechanically as differences in future returns, at least up to this approximation error. This is not true for differences in price book ratios. So differences in price book ratios that are not explained by future earnings growth could show up as future returns, or it could just be related to this current earnings to book ratio component. Now, because price book ratios have this extra component in them, what we find is that the price earnings ratio tends to be a stronger predictor of returns than the price book ratios. So specifically, we're going to regress cumulative returns on both the price earnings ratio and the price book ratio using time fixed effects. And what we'll find is that estimates just based on price book ratios tend to understate long-term return predictability. So specifically, this table is showing the regression coefficients for different horizons from 1 to 10 years. What we show is that if you do separate univariate regressions, we find that the price earnings ratio is a stronger predictor of returns than the price book ratio. So in terms of coefficients, we get a larger negative coefficient for the price earnings ratio than the price book ratio. And in terms of R squared, we find that the price earnings ratio accounts for more of the variation in future returns than, say, the price book ratio. More surprisingly, we find that if you do a joint regression using both the price book ratio and the price earnings ratio, the price book ratio basically drops out. So once you include both ratios, really all of the emphasis gets put on the price earnings ratio, and almost no weight gets put on the price book ratio. And another way essentially to see this is the joint regression gives very similar R squareds to just using the price earnings ratio by itself. So it seems like all the information in the price book ratio is being picked up in the price earnings ratio. The last point I'll make here is that this difference between the price earnings ratio and price book ratio pretty naturally leads to a profitability anomaly. So if the price book ratio essentially is a noisy proxy for the price earnings ratio, then controlling for that noise will help you to predict future returns. And specifically, what we find is that if you're using the price book ratio to predict returns, Then including the earnings to book ratio, so a measure of current profitability, will essentially show up as an additional factor that helps you to explain future returns. So this is arguing that perhaps the price book ratio and profitability may just be two representations of one factor that's driving returns. In this case, the price earnings ratio. Okay, for my last point, let me just wrap up with some results on price ratio innovations and current returns. So if we use the VAR model from earlier, we can take the fact that price earnings ratios are approximately future earnings growth minus future returns, and we can look at innovations. So unexpected changes in price earnings ratios have to be due to revisions in expectations of future earnings growth or revisions in expectations of future negative returns. Now, when we do a variance decomposition for these innovations in price earnings ratios, what we find is that revisions in expected future earnings growth are relatively small. Instead, revisions in future returns are about twice as large. And there's a pretty large covariance between the two, where an increase in the price earnings ratio leads to a positive revision in expected returns, as well as a positive revision in expected earnings growth, and a positive revision in expected negative returns. So there's a pretty big covariance between the two. Now, why might this result be surprising? It's because previous estimates based on returns have found a fairly large role for future cash flows in explaining realized returns. So if instead of looking at price earnings ratio innovations, we look at surprise returns, we have a similar relationship where the unexpected return is equal to changes in expectations of earnings growth plus changes in expectations of negative returns. But there's a bit of an asymmetry where the returns only deal with future returns. So it's starting at j equals 1, whereas earnings growth deals with current earnings growth, j equals 0, as well as future earnings growth. So to make this clear, we basically break out these two pieces. So there is the surprise from current earnings growth. There's revisions to expected future earnings growth, and then revisions to returns. Now, once we decompose the variance of unexpected returns, we now find a very large cash flow component in line with these previous papers. But what we want to emphasize is that this is due to the surprise about current earnings growth, not due to the revisions. So we already know from the last exercise that the revisions have fairly low volatility. This extra volatility that's now making this cash flow component so big is due to the fact that we have this current cash flow growth surprise. So what this matches is, say, a world where earnings growth is very volatile, but hard to predict. That would give you very volatile surprises, but small revisions in expected future earnings growth. So again, what we want to highlight is that information about future earnings growth is still fairly small in this case. Okay, now that I'm right at the 40-minute mark, let me just wrap up here by saying that the three main results we kind of want to highlight here are that first, the cross-section of price ratios is mostly about future returns, not future earnings growth. In fact, we find that about 75% of differences in price earnings ratios show up as returns. Only about 25% show up as differences in future earnings growth. This holds both for the level of price ratios as well as innovations in price ratios, so changes over time. Importantly, we want to reconcile our results with the past literature. So we're not claiming that any of the other results are incorrect, but we just want to emphasize that these shouldn't be taken as evidence that earnings growth is highly predictable in the cross-section. So we agree that there's a strong link between price book ratios and profitability, but this seems to mostly be due to this past component related to book. There is a link between returns and cash flow shocks, but that's mostly about the current realized cash flow shock. It's not that returns on stocks are highly informative about future cash flow shocks down the road. And what I didn't go through is that we showed that the lack of earnings growth predictability actually strengthens return predictability. Overall, these results motivate models in which future earnings growth is really just a secondary part of valuation. And instead, valuation is largely driven by mispricing or substantial risk premia. And that's kind of the open puzzle that we're still attempting to resolve, is how most of these differences in price ratios could be showing up as returns. All right, and I really look forward to John's discussion.
Great, Sean, thanks so much. As Sean just mentioned, we said earlier, John Lewellen will be conducting the discussion. John?
Great. You see that okay? Hear me? All right. All right. Well, thanks a lot for, sorry, rearrange these windows for just a minute. Thanks a lot for asking me to discuss this. It was a lot of fun to look at, read, and understand. Sean had come to present this at Talk About, I think about a year ago, give or take. And I remember at the time thinking that it was, the results were really intriguing, and there were a lot of details that in a seminar I couldn't quite absorb, and I was interested in understanding. And so this gave me a good opportunity to get into the paper and sort of understand some of those details and really understand, I think, what's going on. And really what my discussion is going to do is just to provide a little bit of a summary perspective of how I understand the contribution of the paper, and then offer some thoughts on comments, and so on. Sorry, get this, and suggestions for things the authors might do. So, okay. So the big question that, as Sean talked about nicely, is we're trying to understand here what explains variation in stock prices. And from just simple present value logic, if stock prices change through time or across firms, that has to be explained by either information or expectations of future cash flows or expectations of future returns. So if we see the market goes up, it's either got to be explained by cash flows of the market have gone up, or if cash flows are held constant and the market goes up, that says that future returns have to be lower. And so that's the simple question here, is trying to understand which of those two terms, cash flows or future cash flows or future returns, really explains variation in stock prices. As Sean talked a little bit about the conventional wisdom, and I think this is the way they describe it in the paper, and I think it's accurate, is that cash flows are really important when we're looking at cross-sectional differences in stock prices or valuation ratios, but expected returns are really important, are really the dominant factor if we look at the aggregate time series. I'm trying to understand why the returns, the prices of the S&P 500 change through time. Just to give you some numbers to sort of think about. So the cross-sectional, I think a standard reference here is Cohen, Polk, and Voltanaho, and they estimate that roughly 75% of the cross-sectional variance in price to book ratios can be explained by differences in cash flows, in profitability, as we'll talk more about. Standard reference that you see for the aggregate is Cochran's paper, where he estimates that essentially 100% of the variation in the aggregate in the S&P 500, or the aggregate price to dividend ratio, is explained by changes in expected returns going forward. And so that's sort of consistent with this conventional wisdom. One of the things that always surprises me a little bit when people quote that is that if you look at John's paper, his estimate is 100% can be explained by future returns. The standard error of that is about 44%. And so, yes, the point estimate is 100% is explained by future returns. It could be as small as 30, 40%. So taking that as a point estimate and taking that as a serious estimate seems a little bit generous to me. So anyway, obviously, this paper is going to be focusing on the cross-section and really, to some extent, trying to provide a new perspective on the relative importance of cash flows and discount rates in that, and really sort of trying to offer a new perspective on what's going on there. Statistically, when we talk about what drives variation in stock prices, that's not a very well-posed question statistically. And so what we normally do when we take this to the data is refine that to saying what explains variation in valuation ratios, in price dividend ratios, price earnings ratios, price to book ratios. And one of, I think, the nice insights in this paper is that which one of those ratios you focus on actually is important. That in particular, what explains variation in the price to book ratio is in some sense fundamentally different than what explains variation in the price dividend ratio or the price earnings ratios. And that's something that I think really comes out nicely in this paper and probably hasn't been sufficiently appreciated in the literature. And so a lot of what the paper is doing when it's talking about reconciling the results with the prior evidence is sort of emphasizing the distinction between price to book versus price to earnings, and that's an important distinction. So let me just talk quickly about that idea. So again, everything in here is some variation on the Campbell-Shiller decomposition. Just to quickly review, it starts with just the simple definition of returns. In the first line here, you take the log of both sides, you linearize it around the log dividend yield, in this case, or price dividend ratio, and then you rearrange it a little bit and you get the second equation on this slide, okay, which says today's price dividend ratio is related to dividend growth next year, returns next year, and then where the price dividend ratio ends up a year from now. Okay, and so that's just a basic mechanical decomposition, trying to understand what's explaining price dividend ratios or returns, depending on what you're emphasizing in this equation. What Campbell-Shiller do is just say we can substitute in for PD T+1. So this is showing what price dividend ratio today is in relation to future price dividend ratio. You can continuously, forward iterate that as much as you want, and you get what I have there in sort of the second part of that. So that's the standard Campbell-Shiller decomposition, which says the price dividend ratio today is related mechanically to either future dividend growth rates or future returns. Okay, and that's pretty standard. That's just saying if the price dividend ratio today is really high and we think it mean reverts, it's going to come back down. That's either got to be dividends come up or prices go down or returns are low going forward. So everybody knows that basic idea. What this paper tends to do is focus more on the price earnings ratio. I think, I don't know if this is original to this paper. I guess I haven't seen this specific decomposition before, but basically they just show that instead of working with price dividend ratios, we can work with price earnings ratios, and the formula works exactly the same. So, it's easiest to see if the dividend payout ratio is constant, then the first, then that part and that are just identical, and it should hold approximately even if price dividend ratio or if dividend payout ratios aren't constant. So that's going to be that, and it's going to be important as I go down these different lines that DR, the component that's explained by future returns, that's always going to be the same thing. So the only thing I'm really going to be varying from one line to the next is what are we looking at? Is it dividend growth rates, earnings growth rates, or whatever? As Sean mentioned, when people focus on the cross section, so this comes from Cohen, Polk, and Voltanaho, instead of working with PE ratios, the convention, I think going back to probably, Fum and French's evidence that book to market is important, has been to focus more on price book ratio or the market to book ratio, in which case you get this decomposition, okay, where the price book ratio today is related to, again, future returns, but in this case, future profitability, ROE. Okay? And again, one of the things that I think is nice about this paper is that it really spends some nice time thinking about how what's in that equation is really subtly different, but important in an important way, different from the first two equations, the price earnings ratio or the price dividend ratio. And that's in the sense that the first two equations are really fundamentally about the first term in terms of cash flows is really looking at future growth rates of dividends or earnings. And the price to book ratio of Cohen, Polk, and Voltanaho is really looking more at the level of cash flows or the level of profitability. Okay, so this distinction between levels and growth rates is an important distinction, and that's a big part of what's going on in this paper. And in particular, you can just sort of rearrange these equations and rewrite the price to book ratio in terms of its current sort of earnings to book ratio. So EB there is the earnings to book ratio, and then future growth rates and future dividend yields, or discount rates, expected returns. And so in a lot of what they're talking about is like this price to book ratio has this additional component that explains variation, that's driving variation, and that's the current ROE, basically, the earnings book ratio. Okay, but fundamentally, everything in this paper is about one of those different equations here. Real quick, I'll just go through what they do just to highlight a couple of things. They're looking at this in the cross section with price to book quintiles. These are a little bit different. I think is useful to emphasize. These are a little bit different than I think standard price to book quintiles in the sense that the breakpoints they use here, if I understand correctly, are putting equal value in each of the 5 portfolios. That's different than what, like, say, Fama and French would do, which is using what, and I'll show you some numbers in a minute, using like NICE breakpoints, okay, where most of the value shows up in the growth portfolio and only a little bit of the value shows up in the value portfolio. So these are a little bit different than standard, and it would be nice to sort of see a little bit more how important that is. All right, so just real quickly, just to highlight, I mean, Sean did a nice job of summarizing this. This is really sort of the essence of the paper, is that if you're looking at what explains variation in this slide in the log PE ratio of firms or across these 5 portfolios, much of the variation is explained by future returns, the discount rate effect, if you will, that's the second column there, and only a relatively small amount or a smaller amount is explained by future earnings growth rates. And that's really sort of the essence of the paper. I won't go through the price to book ratio decomposition, but sort of the message is the same. It's just there's an additional component on there. But in some ways, these numbers are actually very close to the Cohen, Polk, and Voltinaho estimates. They're not exactly the same, but they're actually pretty close to it. So just real quick, I know we're sort of low on time. These results, I think, are really interesting. They're in many ways quite striking. And the last few comments I'll have is really an appeal to the authors to help us understand what's going on in the data much better. In a sense, be much more transparent, much more simple in describing what's going on, because these numbers are interesting, they're big, they're surprising, and I personally find it hard to understand exactly what's going on. And so I think some very simple statistics, some descriptive statistics in a sense, would help us really understand, would make these results stand out much more dramatically. So what I mean by that is, let me just give you 3 sets of numbers really quickly here. And I should emphasize, these are going to be my data. So these are my portfolios. I have not tried to replicate what they've done in the paper. And so my numbers here may not carry over to the numbers they have in the paper. Okay, so this is just more an illustration of the kinds of information, the information I'd like to see in the paper that would help me understand what's going on. Not supposed to represent the results they have. So here I'm going to be just showing my book to market quintiles using what I think of as relatively standard approaches, NICE breakpoints, and so on. So it's a little bit different than their data, but should be similar. One of the things I would really like to see is just basic numbers for these portfolios, which is, what are the price earnings ratios? What are, or the earnings yield? What's the price to book ratio for these portfolios? Okay, what are their returns? We're summarizing, like with cross-sectional standard deviations, we're summarizing 5 things into one. We got plenty of room in a paper. We can put all 5 in, right? We don't really have to summarize this as a standard deviation. We can just show the numbers directly. So, for example, just to highlight a few issues, we're looking at price to book portfolios here. Obviously, we're going to have very large cross-sectional variation in price to book ratios. What I've got in the bottom row here is like the ratio of the top row to the bottom row. So, or the difference depending on if it's a log or a raw. But there's sort of a 7-fold difference between the price to book ratio of growth stocks and the price to book ratio of value stocks. That's the top row divided by the bottom. In log terms, it's a log difference of 2. These portfolios are not sorted on price to earnings. And so we're going to get naturally a lot less variation in the price earnings ratio. Okay, so if you look at the top row versus the bottom, it's sort of a 2-fold difference in PE ratios, or a log difference of 0.76, right? So it would be really nice to see how much variation there is in their data in order to understand when we talk about 25% or 50%, in order to understand what that means. And one of the things I think that's useful to keep in mind is there is a lot more variation just mechanically in these portfolios in price to book ratios than price earnings ratios. So it's about a 2.5 or threefold difference if you look at like the log terms. Okay, so that's one number I'd really like to see. I'm going to skip this in the interest of time. Related to that is I'd like to see a lot more information about how much of the variation, cross-sectional variation in PE ratios we're really picking up with these portfolios. Okay, and just to sort of illustrate that, what I've got here are my book to market portfolios compared to my PE ratio portfolios or earnings yield portfolios. One of the problems with using earnings in the cross-section is lots of firms have negative earnings. So I've got rid of the logs in this slide, and I've just reported this as book to price, as standard book to market, and earnings yield. And again, one of the things I think that would be really nice to see is what is sort of the amount of variation in PE ratios, or in this case, earnings yield ratios in their data versus what you would get if you looked at either the raw cross-section or, in this case, earnings to price portfolios. Okay, so there would appear, based on this, a lot of variation in PE ratios cross-sectionally that is missed in their book to, in mine, I should say, in my book to price portfolios. And it would be nice to understand how much of it they're picking up and how much is unexplained. The last thing I'll say is it would be really nice just to see basic descriptive statistics for what are the returns on these portfolios. Okay, so here I'm reporting my estimates for my portfolios. Again, these are going to be different than theirs, of what are the discounted, that DR term, what is the discounted sum of future log returns for each of these 5 portfolios over 1 year, over 5 years, over 10 years, or over 15 years. That's an easy set of numbers to report. I think that would go a long way to understanding when we're talking about what are these cross-sectional regression slopes, what do those actually represent? One of the things I think would be really nice to understand is, one of the things that I think that is well known is the value premium has diminished dramatically over the last 10 or 15 years, right? So in my data, using these portfolios, I actually don't see a significant spread in the returns between my value and growth portfolios over 5 years, over 10 years, over 15 years. It would be really, and yet they're saying there's a huge amount of variation across their portfolios in this. It would be really interesting to understand exactly what's going on, to see what these numbers look like for their portfolios, because these numbers seem to, the significance here seems to be smaller than I would have sort of inferred from their data. Again, I'm sure there's lots of reasons for that. These are different numbers, but something like this I think would help us understand what's going on. Let me just end there real quick. I've got some graphs of that, but not important. I think this paper has a lot of really nice insights for understanding sort of what's going on in the cross-section, for really illustrating and highlighting a couple of really important issues. I think mostly what would be nice is if they just report some more basic statistics that would allow us to understand what's going on. So I'll stop there. Thanks a lot. That was great.
Right, John, yeah, thank you so much, John, for your discussion. Sean, I'm going to give you just a couple of minutes to respond. We're running a little bit long in the tooth here, but a lot of us will be interested in your response. And then we'll open it up for questions. We have a little bit of a list here, and we'll get those to you next.
Sure. Yeah. So first off, really appreciate the discussion. So just running through a couple points here. So it's completely accurate that we put an equal amount of value in each of the portfolios. This was because we wanted to ensure our results weren't just driven by, say, one portfolio that represents a very small share of the market. We wanted to kind of say, if each portfolio is 1/5 of the market, how do we decompose the variation? But that's totally fair that we could do an equal number of stocks, say, in each portfolio. Now, to the broader question of the portfolio sorting, it's exactly right that because they're sorted by book to market, they have more variation in price book ratios than in price earnings ratios. We do show a similar exercise looking at earnings yield sorted portfolios. And then we also do the firm level decomposition, where that's all of the variation. So there's no concern there that kind of we've reduced variation by aggregating to portfolios. That's just taking all possible firm level variation, admittedly, we weight everything by market value. So we treat Apple as having a lot more weight than a tiny company in that estimate, but we are looking at the full firm level variation. And then the broad idea of descriptive statistics, I think, is completely reasonable, essentially, of just trying to provide as much transparency, because we want to lay out that this is a bit of a puzzling element. And yeah, the more we can lay out in terms of what the return differences are, I think the more helpful that would be. We find roughly a 3 to 4 percentage point return difference between, say, the high and the low portfolio. The main thing is that it just is very persistent. So at short horizons, it doesn't have a massive effect on price, but it really starts to accumulate. To your point about the more recent return samples, we had found that in more recent samples, the value premium, at least at the 1 or 2 year horizon, had really disappeared, but at longer holding horizons, it had remained. So I'll be curious to talk with you there. I don't know if the difference is because we're regressing it on the price earnings ratio and using that as a predictor rather than doing the high minus low spread, but that's certainly a point I'll want to dig into more, and I don't have an answer off the top of my head there. But yeah, these are all really fair points. I really appreciate the time for going through it all.
Great. Thanks, Sean. And again, thanks, John. Well, everybody, we're out of time. Thank you so much for attending. And thanks to our two guest presenters, Sean Myers and John Lewellen. Guys, thank you so much. Many thanks to our center staff who are critical to our activities, of which today's webinar is certainly an evidence. Lauren Hurry, who's the Managing Director of Finance Research Centers at Wharton, Chris Trollen, our Senior Associate Director of Events, and Jason McHugh, our Senior Communications Specialist, and of course, my co-academic director, Craig McKinley. If you'd like further information on the paper or the Jacobs Levy Center, please do visit our website at Jacobs Levy Center, all one word, .wharton.upenn.edu. Also, I should highlight our upcoming Frontiers in Quantitative Finance Conference, which this year will be held in September, on September 20th on campus in Philadelphia at Wharton, and we hope to see you there. Thank you, everybody. Have a wonderful day.
Thank you, everyone.
Thanks, guys.